And I will share my screen. All right. So I've talked about balance sheets and the format of the balance sheet. And I gave you guys some of the information that you're going to get in Chapter 4 already, but we're going to talk about classified balance sheet in more detail. So a classified balance sheet, it classifies the assets into current versus long-term, the liabilities into current versus long-term, and the owner's equity. Can you mute your mic, please? I hear echoing. Whoever doesn't have their mic muted, please mute your mic. Unless you want to ask a question, of course, in which case you can unmute it, no problem. Thank you. So current assets, these are cash and other assets that can be converted to cash or used up within the normal operating cycle or 1 year, whichever is longer. So that's the technical definition of a current asset. But for all intents and purposes, you could just rephrase this as, excuse me, you could rephrase this as cash and other assets that can be converted into cash or used up within a year. So this phrase, within the normal operating cycle or 1 year, whichever is longer, technically that's what GAAP requires, but most companies' normal operating cycle is less than a year. So a year is usually the longer of the two things. And so we'll just use a year. And what is a company's operating cycle? It's essentially the amount of time that goes by between, take Apple Incorporated as in this example. It's the difference between whenever they receive the cash from, no, I'm sorry. It's the difference, it's the amount of time that goes by between whenever they first purchase the materials that they're going to use to make their product and whenever they sell their final product and receive cash from the customer. The amount of time that takes, and for most companies, hopefully that's less than a year, else you're not very good as a company. So usually a year is longer than the normal operating cycle. But for some rare examples of companies, maybe the normal operating cycle is more than a year, in which case the definition of a current asset would be cash and other assets that can be converted into cash or used up within the normal operating cycle. But usually a year is the longer of the two, so we'll just use a year. We have a question in the chat. Let's see. Tyler says, can you go back one slide? Sure, Tyler. There you go. You're welcome. So here's an example. We have Apple. Here are their current assets. This is just a partial balance sheet, of course, just the current assets part, cash, short-term investments. Don't worry about those for right now. We'll talk about them later. I mean, this, for example, could be the dollar value of the stocks that Apple holds. Say they've invested in stocks of other companies and they intend to sell those stocks for cash within a year. Then that would be classified as a current asset. So accounts receivable, inventory, other current assets like prepaid rent, prepaid insurance, prepaid whatever, all those things, supplies, for example. And you try to list them in order of liquidity. So long-term assets, these are assets that a company does not expect to convert into cash within a year. Examples are PP&E, property, plant, and equipment. Intangible assets, and other long-term assets, like maybe some long-term investments. Common examples of property, plant, and equipment. Land, that's property. Plant, those are buildings. Equipment, that's equipment. Vehicles, furnishings, those all fall under the category of equipment. Intangible assets, examples. Well, first, the definition. These are just assets that lack a physical presence. So like intellectual property, or the right to be able to, produce something and you're the only one that has that right because you have a patent. And we'll talk about these in a little more detail later, not in this chapter, but common examples of intangible assets are brand names, copyrights, patents, trademarks. Goodwill is another example. But don't worry so much what each of these things are in this chapter. Just know that intangible assets are assets that lack a physical presence, and that some common examples are copyrights, patents, trademarks, so forth. Current liabilities. These are liabilities that need to be satisfied within a year. Technically within the normal operating cycle, or 1 year, whichever is longer. But again, a company's normal operating cycle for most companies is less than a year, so a year. Examples are accounts payable, all the various accrued liabilities like wages payable, rent payable, utilities payable, all these, a multitude of various accrued liabilities. And a lot of times the company will just sum those all up and just call them accrued liabilities, or or accrued expenses, because when you book the liability, you recognize the expense with it. So calling them accrued expenses, because of the word accrued, they're a liability. Just like when we say unearned revenue, it's not a revenue, it's a liability. So deferred revenue. Deferred revenue is unearned revenue. Deferred, unearned, same thing. And then short-term loans. So these are like notes that you've borrowed from the bank, like short-term notes payable. You borrow from the bank and you have to pay the bank back within a year. Long-term liabilities. These are obligations that are not required to be paid back within a year. So you have more than a year to pay them back, or more than a year to satisfy them. So some portion of deferred revenue was long-term for Apple in 2017. And these numbers are in millions, by the way. It's this number times $1 million is the actual amount. So some portion of their deferred revenue was long-term, which means Apple wasn't required to perform the service or ship the good. They had more than a year to do that, according to the contract that they had with various customers. And so that, by definition, is a long-term liability if you have more than a year to satisfy it. And then long-term debt, these are long-term notes payable, bonds payable. Bonds payable is an example of long-term liability. Stockholders equity, you know all this already. It's the leftover ownership interest in the assets of a company after all of its liabilities have been paid off. It's equal to assets minus liabilities, aka. It's what the shareholders get If the company goes bankrupt and they liquidate the company, they sell off all the assets, they pay off all the liabilities, and any money left over after paying off all the liabilities, that's the money that the shareholders get, stockholders' equity. It consists of two major categories: the amount invested by shareholders, the contributed capital, common stock, and then the earned capital, the amount of money that the company has earned from selling their products and services that hasn't been distributed back to the shareholders in the form of dividends, aka retained earnings. And don't worry about examples of other equity. We'll get into that later. So there's two ways you can present the balance sheet, and I told you this before, but I didn't give you the formal definitions. So the two formats are account form and report form. Account form is the one that we don't really do very much, where we put the assets on the left and the liabilities and owner's equity on the right. In class, I've been using the report form, which is where assets are on top and liabilities and owner's equity are below. And this is the full Apple Incorporated balance sheet. Actually, these are comparable balance sheets, classified balance sheets for 2017 and 2016. Apple's fiscal year ends September 30th of a given year. Hannah wants me to go back a slide. Sure, I can. Right here. You're welcome. All right, let's go forward. You see, this is Apple's balance sheet. And again, these numbers are in millions. That way they don't have to write a huge number here. I mean, this is a huge number. Apple's checking account balance in their checking account is 20,289 times 1 million. That many dollars. What would that be? Would that be 20? Would that be 200 million? 20,289 times 100,000. No, it's 20 billion 289 million. Good grief, they're rich. Which of the following is not a subgroup on a classified balance sheet? What do you guys think? Right. You don't see net sales revenue anywhere on a balance sheet. That belongs on the income statement. Thank you all. Good job. Speaking of income statement, let's talk about income statement formats. There's two formats. There's the multi-step and there's the single step. So a multi-step income statement presents revenues and expenses in distinct categories to aid in financial analysis. So here's an example in this first column of a multi-step income statement for a company who does a service company. They don't provide a good to the customer, they do a service. So their revenues would be listed. Then we would subtract their operating expenses, which are broken down into selling and administrative. And can you mute your mic, please? I hear noise in the background and it's distracting. Unless you're going to ask a question. Thank you. So revenue minus operating expenses equals income from operations. And then we either add or subtract any other income or expense, any other revenue or expense that's not related to our normal operations. Things, for example, like interest revenue, interest expense. And then that equals our income before income taxes. And then we subtract our income tax to get our final net income number. Now, if you're a merchandising company, which means you don't provide a service to the customer, you actually provide a good to the customer, then you break down your upper part of your statement this way. We have our net sales revenue. Now, net sales revenue itself is a calculation. Net sales revenue is equal to the gross sales revenue minus any sales returns, discounts, or allowances to get the net sales revenue. We'll talk about that in a second. So net sales revenue minus cost of goods sold expense equals gross profit. Then we take our gross profit, and from that we subtract our operating expenses. And then, so from the gross profit line, it looks the same for a merchandising company as it does for a service company. It's just the merchandising company has this gross profit line. Because service companies don't sell goods, they do not show a cost of goods sold. Net sales revenue. So there's an account, there are two accounts. Sales returns and allowances, that's one account, and sales discounts, that's another account. Both of these accounts are contra accounts to sales revenue. Sales revenue is a revenue, it has a normal credit balance. Sales returns and allowances and sales discounts, since they're both contra accounts to sales revenue, they both have normal debit balances. What does the account sales returns and allowances represent? It represents the dollar value of goods returned to the company by the customer. And the company has to turn around and give money back to the customer. So if the company originally had recorded revenue when they shipped the goods to the customer, well, they have to undo that, because when the customer gives the goods back to the company and the company gives the customer some cash back, the company has to sort of undo that revenue, but they don't undo the revenue by debiting the revenue, by debiting sales revenue. For the same reason that whenever a company has a piece of equipment and they want to recognize depreciation, they don't credit equipment, they credit accumulated depreciation, which is a contra account to equipment. Same thing with sales revenue. When your customer gives you some goods back, you need to unrecognize some of the revenue you previously recognized. You don't debit sales revenue, you debit sales revenue contra account, which is sales returns and allowances. Also, sales discounts is a contra account. We'll talk about sales returns and allowances, sales discounts, and their relation to sales revenue in more detail in Chapter 5. But just know that to get net sales, we take sales revenue minus the balance in the sales returns and allowances account, minus the balance in the sales discounts account, gives us our net sales revenue. Just know that for the exam 1. So gross profit is net sales revenue minus cost of goods sold. Gross profit represents the dollars that are left. So think about let's do a simple example, a retailer. Say a bike retailer. They buy bikes and then they mark up the price of the bikes and sell them to customers. So suppose you sold 6 bikes this period and you sold them, let's say, for $100 each. So your sales revenue, and your customer didn't return any of the bikes to you and you didn't offer any discount. So your net sales revenue, which would equal your sales revenue, is $600. You sold 6 bikes at $100 each. What's your cost of goods sold expense? Well, we need to go figure out, what did we originally pay for those 6 bikes? Suppose you originally paid $50 for each of those 6 bikes. So your cost of goods sold is $300 this period. You sold 6 bikes, each for 100. So your revenue was 600. Those 6 bikes, you originally paid 50 each. So you originally paid 300 for those 6 bikes. So your cost of goods sold is 300. So your gross profit would be $300. 600 minus 300 is $300. It's the amount of money you have left over after taking care of the original cost to buy the item or to make the item if you're a manufacturer. It's the amount of money you have left over to cover your operating expenses. Examples of, operating expenses are any selling expenses like advertising expense, any commissions you pay your salespeople to sell the product for you, all of your salaries for your administrative folks, your wages, insurance, so forth. Rent. So this idea of operating expenses on the income statement, these are the expenses that we had to incur that relate to our primary reason that we're a company, our primary operating activities. Any other expenses or revenues would go down in this other category. They're not part of your primary operating activities. So if we take the bike example again, their primary operating activity is selling bikes that they previously bought. So what would be an example of a revenue or an expense for the bike company that's down here in the other category? An example would be, suppose the bike company lended another company some money, and they charge that company interest. And so every month the bike company will get interest from that other company, interest revenue. That interest revenue they get from lending that other company money is not revenue from selling their bikes. It's just from, the fact that they're a lender. So it's not their primary reason they exist. So that would go in the other category. Same thing on the other hand for the interest expense. If the bike company borrows some money from another company and they have to pay interest on it, that would not be a primary operating activity expense. It'd be an other expense. Other examples, which we'll get into later, are gains or losses. Like suppose the bike company sells one of their pieces of equipment and they realize a gain on it. That gain would show up as a revenue in the other category. Or what if they realize a loss on the sale of the equipment? That loss would show up as an expense in the other category on the income statement. We'll talk about gains and losses from selling property, plant, or equipment in a future chapter. All right, so which of these is not part of a multi-step income statement? Right, you won't find anything about assets or liabilities or owner's equity on an income statement. All right, now let's talk about some ratios. So this chapter up to this point essentially has just had a lot of qualitative things, just memorizing definitions and formats and stuff like that. But the quantitative part of this chapter is in the ratios. Mike, excuse me. I have something in my throat and I can't get rid of it. So ratio analysis expresses basically what's the definition of a ratio. It's just expressing one relevant number over another relevant number through division. And as literal as we can be here. It helps to provide a basis for analyzing a number. Good grief. I'm sorry. Analysis of ratios can be improved through trend analysis. And this is making comparisons over time within a given company. Looking how this company performed, this year versus last year, same company. Whereas benchmarking is looking how this company performed relative to its competitor just this year. Another example, or another name for trend analysis is horizontal analysis. So we take the same company and we just look at how that company's, say, net income looks this year relative to last year, relative to 2 years ago, relative to 3 years ago. Or I guess you could call this vertical analysis. I won't get into horizontal versus vertical. Just trend analysis is taking one company, so we hold the company constant and we vary time. And benchmarking, we hold time constant and we vary company. All right. Looking at the balance sheet, we can get information about the firm's financial health. We can identify how assets are funded. Are they funded primarily through debt, through equity, through retained earnings? So as an investor, if you're looking at a given company and you're deciding on whether you want to invest in that company or not, you would want to assess the company's liquidity and solvency. So liquidity is the company's ability to pay their short-term financial obligations. In other words, how much cash and how quickly can they raise cash? How much cash do they have and how quickly can they raise cash? And so a common ratio that you can use to assess the company's liquidity is the current ratio. You just take current assets and divide it by current liabilities. Obviously, you want this ratio to be bigger than 1 or bigger than or equal to 1. If it's less than 1, that means current liabilities are bigger than current assets. And that's not good. That would mean that the current obligations, the obligations they have to satisfy within a year, are in dollar value are greater than the dollar value of the assets they have to satisfy those obligations. So you want the current ratio, if you're a company, you want your current ratio to be bigger than 1. Sure, Emily. So with the balance sheet, we're going to be looking at, you're welcome. We're going to be looking at 2 ratios. One ratio will assess the firm's liquidity, and the other ratio, liquidity again, is the short-term, the ability to pay their short-term obligations, and solvency is the ability to pay their long-term financial obligations. And we use another ratio to assess their solvency. So solvency is a measure of the company's ability to survive over the long term. And the ratio that we're going to use to see how good they are at, at solvency is the debt to total assets ratio. So this ratio is just total liabilities over total assets. So it's like the flip-flop of the liquidity ratio. But instead of current, we have total though. So the company would want this ratio to be less than 1. They would want the total assets to be bigger than the total liabilities. And that would make the ratio less than 1, since total assets is in the denominator. Companies that have a debt to total assets ratio that's greater than 1, they are more risky to invest in. They're going to, in the long term, they may not be able to pay back to satisfy their obligations. and they might go bankrupt. So you want to invest in companies whose debt to total assets ratio is less than 1. Why is it flipped? Ariel asks. It's just the way it is. That's just the way that the ratio is defined. They could just as soon as called it total assets over debt, over total debt, call that the ratio, but they decided to name it debt to total assets ratio, and that's the way it is. No particular reason other than that. It's kind of weird why it has to be that way. You're welcome. I don't know why they can't just be consistent. That's just the way it's been like that for forever. All right, so 2 ratios that we can use to analyze the company's balance sheet. One ratio assesses their liquidity, the current ratio, current assets over current liabilities. And the other ratio assesses their solvency, total liabilities over total assets. Now, a third ratio we will use to analyze a company, and this ratio will assess their profitability. And we get it from the income statement. The ratio is return on sales. It's net income over net sales. So again, the numerator, net income, that's equal to net sales minus all the expenses. So we could rename this, or we could reformulate this ratio. It's net sales minus all the expenses divided by net sales. This ratio, by definition, cannot be bigger than 1. If there was no expenses, then the ratio would equal 1. But as long as there's some positive expenses, then the ratio is going to be smaller than 1. So the ratio is going to be between, it could be negative if your numerator is negative. But the ratio usually for most companies is between 0 and 1. And you want it as close to 1 as possible. One way to interpret this ratio, say you get a return on sales ratio of 0.4. That means for every dollar that the company sold, they got to keep 40 cents of it. And the other 60 cents went to cover the expenses. All right, and then let's look at owner's equity. There aren't any ratios we're going to learn to analyze the company's owner's equity. So this slide is literally just review. It should just be review. Excuse me. You guys know everything that's on this slide already. So no ratios with the owner's equity. So 2 ratios with the balance sheet, current ratio and debt to assets. And then 1 ratio with the income statement, return on sales. And then there's going to be 1 difference. It's not a ratio, it's a difference. It's something minus something. 1 difference that we can use to assess the company's, another way to assess their solvency, but we get it from the statement of cash flows. So 4 things in this chapter that you have to memorize in terms of quantitative, those 3 ratios and then this difference. The statement of cash flows, and I'll show you the difference here in a second. The statement of cash flows, it just highlights how the company's cash changed over a period. How their checking account balance changed, or why it changed. So the difference, suppose it went up by $100. Explain where did that $100 increase come from. So the statement of cash flows will put that $100 increase into 3 categories: operating cash flows, investing cash flows, and financing cash flows. Remember, operating cash flows are any cash inflow or outflow that arise from our normal operations. Investing cash flows are any cash inflow or outflow resulting from us selling or purchasing long-term assets like property, plant, and equipment. And then financing cash flows are any cash inflow or outflow resulting from us borrowing money, getting money from our shareholders, so debt, equity, sorts of things. And so the ratio that we can use to help analyze a company's solvency from the statement of cash flows, it's not a ratio, it's a difference. It's just, we take the cash flow from operations, so the net number from this first category, we take that net number from this category, and we subtract our capital expenditures. And this gives us our free cash flow. Capital expenditures, the definition of capital expenditures. Capital expenditures are the cash outflows, only outflows, resulting from us purchasing long-term assets, property, plant, or equipment. So capital expenditures would be found in the investing activities section, and it's only the outflows. So we take our net cash flow from operations from the operating section, the bottom line number from this section on the statement of cash flows, and we go find any of those cash outflows in this section. We subtract those. Oh, there's a caveat. In the investing activities section, there's inflows and outflows from purchasing or selling long-term assets. The capital expenditures are only those outflows from selling property, plant, and equipment. But we could have sold another long-term asset that's not property, plant, and equipment. Or we could have purchased another long-term asset that's not property, plant, and equipment. And we wouldn't, it would be an outflow, but it would not be a capital expenditure. Suppose we purchase some stock in another company and we intend to sell it more than a year from now. That's a long-term investment. That is an outflow in the investing activities section, but it's not a capital expenditure. So capital expenditures are only those outflows from us purchasing property, plant, or equipment. And they're found in the investing activities section. So which of the following involves an analysis of the income statement? And these are the 4 things you have to know in this chapter in terms of the quantitative current ratio, return on sales, debt to total assets, and free cash flow. Return on sales, that's right, good. So B, which of these things involves an analysis of the balance sheet? A and C. And then which of these things involves an analysis of the statement of cash flows? D. But B is the one that involves an analysis of the income statement. Good. You guys are getting this. And that's the chapter. There's a little slide on corporate social responsibility. Like I told you last time, there's a slide about this in every PowerPoint presentation for every chapter. But I'm not going to go over it because I've already gone over CSR and before. I'm not going to continue to go over every chapter. It is important, but I'm not going to go over it every time. So this chapter, like I said at the beginning, is relatively, there's not a ton going on. I think it's relatively simple. You got to memorize some formats. You got to know how to do those 4 calculations, 3 ratios, and 1 difference. But that's pretty much it in this chapter. So it was a quick lecture today. Do you guys have any questions? If you guys have any questions about anything, you can ask. Nick asks, when is the exam? I went over that at the beginning of this lecture. The exam is, it says on the syllabus, it's next Thursday, October 1st. Emily asks, you're welcome, Nick. Emily asks, how is the exam being administered? It's being administered via My Business course. I'll give you guys more information about it later this week, probably in an email. And then I'll probably talk about it in the on this Thursday in lecture. I'm going to stop recording.